Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And thank you so much for joining us again for another Tuesday afternoon webcast. We're so sorry for the delay getting logged in, but hopefully everyone is tuned in right now. I'm just watching our participants number continue to climb. Joining me as always is David Burrows, our Chief Investment Strategist and President at Barometer Capital. During this webcast, we will provide you with an in-depth look at the macroeconomic environment, and of course, at the tail end of our conversation, would be pleased to address your questions. So don't be shy, please email me at phastings@barometercapital.ca or hit me up on the Zoom link where it says chat or Q&A. And with that, on this lovely Tuesday afternoon, I turn the conversation over to David Burrows. Good afternoon, David.
Hey, Pam. Thanks so much for hosting today. I appreciate it.
Always a pleasure.
Thanks, everybody, for tuning in. It's been a very strong 2 weeks, coming off some of the lows at the end of February. So what we want to talk a little bit about today is where are we seeing strength and where are we seeing weakness? And what does it mean? Does it mean that the correction is over? Does it mean that it is sort of onward and upward from here? Obviously, lots of things to be concerned about going on in the world. And I think for a lot of investors, this has been a difficult 3-4 months where investors have been shaken out of a lot of positions. So the question is, do people reposition? Where should they be repositioning? And kind of what are the risks as we go forward? So let's just blast off. Just as always, I want to start sort of from a high level. We think that we're in a structural bull market in stocks that started in 2013 when we exceeded the highs from 2000, a lot like the bull market we saw that started in 1981 at the end of a very difficult economic period. I think there was a lot of pessimism at the time, and every rally, people asked the question, is that it? Is it over? The crash of 87, 1990, 91, and so on. Lots of troubles along the way. However, it was a great time to be invested in stocks. And the hardest thing to do was to stay in your winning positions. So we think that we are once again in a period like that, and it can go on for a long time, 15, 18, 19 years. We also believe that we're in a new structural bull market in interest rates or bear market in bonds after we saw 40 years of falling interest rates go through a secular bottom in 2020. And, we believe that rates are moving higher from here, much like they did from the early 1950s. When it comes to commodities, again, we look at sort of what is the very big picture and then drill down into the micro. We believe that commodities is the Rogers equally weighted basket of commodities, been in a bear market since 2008. And we think made a reversal in 2021. And what often starts very strong continues to be quite strong, of course, with interruptions. But it looks to us like we've seen a sea change there as well. So these are really important because people wind up positioning themselves for the market they've been in and often have a hard time repositioning for the market we are now in because it seems counterintuitive after a long period of underperformance. There's a lot of hard-held views, but we have to be nimble. We have to make changes in portfolios. We have to try and take advantage of the environment that we are currently in. And that is one that is quite different than the one we lived through over the last several years. Now, two webcasts ago, we talked about the fact that we had 4 very good days in a row. And we had 4 days with a greater than 1% move in the S&P 500 in a row. It has happened very rarely in the past, 1970, 1974, 1982, and 2020. We remember the blast off in November of 2020. And when you looked out 1 month later, 75% of the cases you were higher, an average 1.6%. 3 months later, you were up on average 6%, 75% of the time. 6 months later, in all 4 occasions, you were up 100% of the time with an average gain of 15.8%, and 12 months out, up 100% of the time, up 28%. So fairly compelling numbers. And let's take a look and see what has happened since then. Certainly the S&P, after correcting from top to bottom, about 14% at the end of February, started to work its way higher after that short, sharp sell-off. So we're still about 5% off the highs, still down about 5%, but the market has been making great progress in a very steady rising tape. Now, not just in the S&P, we're seeing a similar picture in the Nasdaq. Now, the Nasdaq, of course, sold off much more significantly. Large cap Nasdaq sold off 22.3%. We know that starting in February of last year, unprofitable tech started selling off, and many of them sold off as much as 60 or 70%, which is similar to what happened in the tech wreck. But after falling 22.3%, Nasdaq has rallied, still down about 9.5% off the highs, but certainly nothing to sneeze at. Now, I want to be a little bit careful on this Nasdaq rally because we know the Nasdaq has been highly correlated to what goes on in the bond market. And when we take a look at a chart that shows in red what's happened to the TLT, or the long US Treasury bond, and what's happened in the Nasdaq, we know there's been a pretty tight correlation between the two. But of course, Nasdaq got quite sold out and has had a sharp rally. I just want to point out that the TLT, or the long end of the US bond market, has continued to sell off, meaning long-term rates rising. So one thing or the other has to change course. It would be very unusual to see the Nasdaq stocks rally if rates continue to start to rise, because they are very interest rate sensitive. You're discounting a stream of earnings far off into the future back to the present using whatever the current interest rate is. And as rates go higher, it means we discount the price down further. So the net of it is both markets have been rallying, and that's a positive. And when we look at it in the longer term, we know that in the bull market of the 80s and 90s, there were several corrections along the way. And certainly we've been seeing the same thing that started in 2013. You had 15, 16. You had a brief bear market in 2018. You had a very sharp sell-off going into the pandemic. And this is the correction that we've seen over the last 3 months. You can see that this latest weekly bar now exceeds the week from the week before. It looks like we may be completing that correction. We'll have to see, but certainly things look more favorable. Now, moving from stocks to bonds, we've talked about how interest rates could have started a long-term secular rise. This is the yield of a 10-year Treasury bond. Going back to 2020, the Treasury bond was trading at about 40 basis points, or 0.4 of 1% return over the next 10 years. We saw rates rally and then consolidate from April of this year, really through year end. We bounced. We thought perhaps this was a check back that wouldn't last. And yes, yields have continued higher. So what that means is that bond prices have continued to fall. Now, keep in mind, there is a mountain of money that has moved into the bond market during the course of 40 years of falling interest rates. Investors got used to the idea. They got their coupon payment, and as rates went lower, their bond prices went higher. So between capital growth and interest payments, they were making a total return that was very attractive relative to the risk that was taken. Now go back and think about buying a Treasury bond with a 0.4 of 1% yield and seeing the price promptly fall 10 or 15%. Not such a great thing for a risk-averse investor. The TLT, the long end of the US bond market, the ETF has fallen 29% since March of 2020. So this has got to be hurting some investors. It's got to be causing some to consider reallocating money from fixed income to something else. Now, maybe that's equities. Maybe it's commodities, because commodities have been behaving much better. Maybe it's dividend paying common stocks that might give them some earnings growth and dividend growth along with the dividend that they got when they bought the security. The net of it is the bond market continues to be in a bear market. This is the ETF for the aggregate US bond market, down 11.5% off the highs. And to put it in context, the sell-off in Treasury bonds that we've seen over the last number of months is the third worst sell-off in history for the US bond market. So as many people know, we've been beating on this drum now for about 2 years with a view that bonds posed a much greater risk than most people have thought, and that we needed to be repositioned for money that was income focused into a different type of security. And that in fact, risk might not be falling share prices, it might be that cash loses its purchasing power, or that bond investments lose their purchasing power. The net of it is, doesn't matter whether we're in the US or around the world, this is the iGov ETF for international treasury bonds. It's off 18% off the highs, and that's across a number of different maturities and issuers. And it's been a very substantial sell-off. Now, when we talk about a generational shift in yields, you can see it best in a German treasury bond. This is the German 10-year yield. This goes back to the early 2000s. You can see a series of lower lows and lower highs, but ultimately between 2019, 20, 21, and now 22, we are seeing a trend change in long-term interest rates. And that's not an unusual thing. Trend changes tend to take time. They don't happen all at once. We saw the topping process in interest rates in the 1970s and early 80s. And we've been going through a bottoming process in interest rates in the US market really since 2015, 16, 17. So it's not a straight up move that we're going to get, but it is important to recognize the secular shift, because it means that the things you need to be invested in longer term look very different than the things you focused on during rising rates, during falling rates. Now, one of the discussions we're going to hear a lot about in the press today and probably over the next couple of weeks is the fact that the yield curve has inverted. What does that mean? Well, for most people, it means that the yield on a 2-year bond now is higher than the yield on a 30-year bond or in a 10-year bond. Now, people will often point out the fact that when the yield curve inverts, it tends to mean that out there is a recession somewhere. Now, people make the assumption that it may be just around the corner, and it's not impossible that it is. The Fed cares more about the curve between the 3-month Treasury bill and the 2-year bond. Because if people thought there was a near-term recession, it would tend to be that the 2-year bond, the expectation for rates 2 years from now, would be lower than it is currently, because there would be an expectation there was a recession in the meantime. That is certainly not the case as it stands right now. Now, what are the real statistics around a curve inversion? These are times when the yield curve inverted between the 10-year and the 2-year bond, going back to 1967. The time between yield curve inversion and recession, let's go down the list: 24 months, 8 months, 17 months, 19 months, 13 months, 23 months, 6 months, the average 16 months. The difference between the inversion and an S&P peak, average of 11 months. So a lot can happen in 11 or 12 months, and it is not a certainty that you wind up with a recession. So certainly something to watch, but not something to get overly excited about in the near term, especially when we have tools to understand the internal health of the market, which we'll talk about as we go along. Okay, so equities look as though they continue their move higher. Fixed income yields look as though the yields are going higher, bond prices are going lower. Let's talk about commodities for a moment. This is the RJI, or Rogers Commodity Index, an index of equally weighted commodities. Started to work its way higher after falling in a bear market from 2007, broke that downtrend in 2021, has been moving sharply higher ever since, and actually for the first time in many years outperforming the S&P 500. But to put it in context, what happened after the Second World War, what happened after the tech bubble, and what is happening currently can go on for a very long time. So we think that we have only just begun what could be a significant run for commodity prices. And just to put a point on it, this is something that happened well before Russia invaded Ukraine. Certainly that exacerbates the situation because the amount of commodities that both Russia and Ukraine produce. But this has been something that's been cooking for quite some time. Let's just run through them. This is the XOP, the Energy Producers Index, continues to behave extremely constructively. And we know that this is becoming a more important part of the market. Certainly it is in the Canadian market. We've highlighted over the last few weeks, we've had inventory drawdowns going on now for months in the US. We know that the US has been selling down their strategic reserve. And frankly, if they continue to sell at this pace, they could draw down the strategic reserve in less than 2 months. But this is still relatively early days. The XOP index fell 90% between 2014 and 2020. Certainly it's been rallying since then, but can rally a long way. Now, when you throw in the exacerbation that comes from the Russia-Ukraine conflict, it's very, very significant. Russia accounts for roughly 10% of global production of oil. Now, that's not the only thing. It's a major producer of various grains, oats and rye, natural gas, 17%, barley and wheat, gold, platinum, coking coal for making steel, nickel, aluminum, silver, the list goes on. So when we talk about energy, we've seen a great turn, but in the S&P, energy today is still at an exceedingly low level as a percent of the S&P versus what it has been in the past, where it's been as high as 15, 16% at peaks. So still early days here and still very constructive. Continuing along the commodities path, the metals miners, both base metals and gold miners, after a long bear market, came out of that bear market only a few months ago and continues to look very constructive. Certainly agriculture continues to look constructive after a long period of underperformance. And given what's gone on again between Russia and Ukraine, Ukraine is a major producer of grains. Russia is a major producer of fertilizer. If you take both of those off the market, it could have a very significant impact. This is what's been going on with fertilizer prices. We just exceeded the highs from where we were in 2007. We all remember what potash did in that bull market. It was a 10-bag stock. So these supply issues have been building for some time. These are aluminum inventories, and certainly these are going to be exacerbated by what's going on in Russia and Ukraine. So we'll be somewhat news-driven by prospects for peace or increased conflict. But behind the scenes, all of these goods are in shorter supply than they have been in a long time. As we're reopening through COVID, because we see a pickup in demand, we think pricing can continue to be pretty strong across the basic materials complex. Now, this is all interesting information, but we make our decisions based on a process. And our process is all about finding parts of the market where we're seeing expansion in breadth. So if you were to take commodities, for instance, energy was one of the first commodities to turn higher, and then agriculture, and then some of the metals producers, and then other alternative energy sources like uranium. We've seen steady expansion in breadth. We spend all of our time looking for parts of the market that are showing expansion in breadth. We know there's no bear markets ever take place when over time a higher and higher percentage of securities within an asset class or geographic region are participating in a rally. That's a healthy thing. We get concerned when we start to see deterioration in breadth, leaders carrying on while the weaklings start to peel away. Because if enough securities roll over, it means there isn't enough buyers in the market and prices can then broadly move lower. So let's take a look at what our data is showing us. When we look back about 4 weeks, we know a lot of our breadth indicators were sloppy. The NYSE was holding up well, Nasdaq was sloppy, and the Canadian market had just turned back positive. Well, that's interesting because the strongest securities turn up first as things start to improve. We know the Canadian market dominated by energy, basic materials, and banking, 3 groups that were early groups to turn higher. We know the NYSE is a more value-driven market than the Nasdaq, which is a more growth-driven market, which was one of the first areas to sell off starting last February. Well, since then, 2 weeks ago, we said basically all of our long-term and short-term indicators, save one, had turned positive. And as we sit here today, all of our major indicators, both short-term and long-term, have turned back positive. So for instance, when we look at the percent of stocks trading above the 50-day or 10-week moving average, as the S&P has moved back higher, so have the percentage stocks trading above the 50-day moving average. But in fact, the percent of stocks trading above the 50-day moving average in the S&P is sitting at 63%, which is higher than where we were in the strongest part of the rally going back over the last year. We talked about the fact that in the sell-off, sentiment very quickly became bearish. In fact, sentiment got more bearish than it was in March of 2020, the height of the COVID sell-off. This is people being concerned that inflation could choke off global growth and we could wind up in recession. Well, that's an opinion, and investors are acting with their opinion. We know that hedge fund managers through the last few months have taken their exposure down to basically the lowest level since April of 2020. So that's from reducing risk. We know that systematic strategies, which are rules-based quantitative strategies, also had been taking down their exposure for months. We know that cash positions as of the end of March were as high as they've been since the worst part of the sell-off in 2020 and from the worst part of the sell-off in 2016. Yet here we are, the last 2 weeks, the market's rallying. So when you ask the average investor how much risk they feel they are taking, they feel they're taking very little risk because they're sitting on cash and they've taken down their equity exposures. Yet what we see in our models is that breadth has turned higher all over the world. All Latin America, breadth improving. All Europe, breadth improving. All Asia Pacific, breadth improving. China, breadth improving. Canada, breadth improving. So somebody's right and somebody's wrong. We follow the market's clues. And I would say it's very likely that those investors who've pulled back so sharply on their exposures are likely going to get squeezed back in the market as the market rallies. For all of those that felt they would buy the dip, I don't think many people did. Now the market's turned and running. And again, today, market's up sharply, I think leaving a lot of investors behind. In our local market, the Canadian market, TSX is making new highs as we speak. So there are haves and there are have-nots. Our job is to focus in groups that are showing leadership, groups that are stronger than the overall market. So let's talk about that a little bit. Our biggest exposure, and has been for some time, is energy. This is the Canadian TSX Capped Energy Index, trading virtually at highs. Being led higher by a lot of the oil companies like Cenovus, like CNQ, Canadian Natural Resources, like Suncor, but also by natural gas companies. Tourmaline is a great example. We know that Europe is looking for alternative sources for natural gas, and there are limited sources globally. They're looking for liquefied natural gas, and one of the only companies that has exposure in Canada to European gas markets is Tourmaline, which is leading the tape higher for the energy producers. Outside of energy, miners continue to behave well. We pulled back a little bit over the course of the week, but we can see we're in a very strong uptrend and doesn't appear to be ready to roll over anytime soon. When we look at the steel index, after breaking out of a years-long bear market and consolidating, steel stocks working their way higher, led higher by companies like Stelco here in Canada and Cleveland Cliffs. Cleveland Cliffs particularly interesting because it is completely integrated all the way from iron ore and coal through to the metal, the steel that they produce, and they control their entire cost and supply chain. Continue to see strength in timber stocks after consolidating, they're turning higher. And agriculture, of course, the first group to turn up after consolidating, is having a big month this month, led higher by the fertilizer stocks and companies that are in the agriculture space like Archer Daniels Midland. So materials overall continue to lead this relative price performance versus the S&P. No change here. On the banks have corrected a little bit over the last few weeks. This is the Canadian Bank Index, US Bank Index the same. We think likely it is a short-term issue, but having said that, as we always do, when something pulls back a little bit, we will cut back our exposure, but they continue to be solidly above long-term 150-day and 200-day moving averages. In particular, in the financials, though, we are seeing strength in insurance stocks, which are making new highs as of today. We talked a little bit about aerospace over the last few weeks. This is the defense sector, Raytheon, Lockheed Martin, Northrop Grumman, and so on. All of them seeing upticks in orders from Germany. Canada talking today about ordering significant number of fighter jets, even though Trudeau said he would never, ever do it. We're seeing a pickup in defense spending all over the world. Other groups we talked about in the last few weeks, consumer staples companies making new highs here against the market still well off the highs. Dividend growth stocks continuing to chug along, making new highs today. This is the Morningstar Dividend Leaders ETF. This, we think, is the theme for income. As opposed to high dividend paying stocks and as opposed to fixed income, we want companies with rising earnings and rising ability to pay a dividend or distribution. A couple of other groups that have led over the last little while. We talked about Reits 3 weeks ago. Well, they've had a very, very good day today. Some areas of Reits giving better dividend growth than others. This is residential Reits. Industrial Reits also look quite interesting to us. And transports over the last 2 weeks have started to lift again. Very important economically sensitive group. Probably doesn't point to recession if the transports are getting going, but also can be helped not just by rail and truckers, but by some of the airlines that are seeing a pickup in traffic and load factors. So lots of groups performing well. We also have seen a pickup in the global infrastructure stocks, certainly probably helped by infrastructure spending in the US, but again, these tend to be dividend growth oriented securities. So look, we don't have to be everywhere. Our job is to target leadership. We have to continue every day to ask the question, are our groups continuing to lead? Are there new leadership themes emerging in the market? If there are, we start with a small position and we'll build on it should it continue to perform well. Very often what leads at the beginning of a rally will continue to lead all the way through a bull market. So while lots of people look to rotate, we need to stay in our winning positions. And if the breadth models roll over, in particular themes or sectors, geographic regions or asset classes, we have to be prepared to make an exit because what we sell is a tactical approach. Certainly, investors can make strategic decisions to have a little bit of money in every asset class. We don't think that that is the best strategy, especially in a world where correlations or the degree to which securities are behaving the same as other securities is falling. We are in a market right now of haves and have-nots. We can focus in the sectors that are showing leadership and we can completely avoid others. Now, the one thing that I would say is that we saw a little pickup in technology this week, specifically cybersecurity. We talked about that 2 weeks ago. And we also saw some strength in semiconductors. So when it comes to looking at where our exposures lie, a couple of things I'd point out. First of all, energy continues to be our largest weight at close to 25% of the portfolios. Now, keep in mind, that's not just oil and gas, it's uranium, it's other sources of energy as well. But relative to the 4% weight in the S&P, it's a very significant overweight. And we think whether or not they solve current conflict in the Ukraine quickly or it takes a long time, the imbalance in supply demand is likely to last a long time. Materials continue to be a very important part of our portfolio, very significant overweight. Financials are now an underweight in the portfolio, given the fact that there are other places for us to focus performing a little bit better. Consumer staples companies have been able to take the rise in input costs and pass them on to buyers of their products and in fact take price on the way through. Profitability is going higher. We are highly suspect of the current rally in technology stocks, given the fact that fixed income continues to behave so poorly and the likelihood of lower rates in the near term is not high. Industrials slowly going higher as the defense stocks perform well, and now transports adding to the mix. We continue to have very low weights in things like utilities, healthcare, consumer discretionary, and cash. So these portfolios, as we sit today, are built for an inflationary environment. We're built for an environment where purchasing power of cash is falling. We need to protect against the risk of inflation. Outside of North America, we've seen strength in some particular global markets. The Japanese market making new highs for the first time since 1991. The Brazil market rallying sharply on its exposure to energy and materials. And when we look at cryptocurrencies, after a sizable correction from December through March, they've started to make a turn. This is Ethereum. A note that when the stock market made its first low at the end of January, Ethereum made a low. When the stock market made a lower low in February, Ethereum made a higher low and didn't travel lower with the market. And since we've seen a turn, we've seen a steady move higher. We've seen the same picture in Bitcoin. And to put it in perspective, on a longer term chart, we had a sizable rally into 2018, 2018 through 21 corrected. We broke out, have consolidated, and looks like we may be ready for the next leg higher as institutions start to adopt investments in decentralized finance in cryptocurrencies. So from a macro perspective, as you would expect, our major exposures are across all of the groups that we're talking about. And from an underweight or short perspective, we're short fixed income and we're short a couple of currencies. We talked about the fact that when Russia invaded Ukraine, it was the sell-off we got was on par with many of the other geopolitical crises we've seen in the past. And we recognized that 1 month out, 3 months out, 6 months out, and 12 months out, most often markets were higher. 12 months out on average, 13%. Well, market's giving us a good start to that. Now we come into April. And April, since 1950, has been the strongest month of the year. There will be corrections out there, but it doesn't look like it's likely to be April. So we're coming through the end of March as we speak. Our breadth models are positive. There's very clear leadership in the market. And out of the last 16 years, 15 of them were positive in April, an average of 3.1%. So we're going to watch every day for signs of weakness in our breadth models. We're going to watch for any sign that various groups that we're focused on are starting to underperform. But we think most of them have structures that would support a very long run higher. But if we're wrong, we're very prepared to get defensive. We've been pretty good at getting defensive in the most difficult quarters and months historically in the market. So with that, Pam, thanks so much. Happy to take any questions, and hopefully this is useful.
Thanks so much, Dave. We do have a couple of questions this afternoon. The first is gold as an investment idea, given the yield curve inversion and potential for recession. I know you mentioned that the miners look like they're hanging on and strong, and specifically, we'd love to get your view on gold the next 16 months, if you can look that far forward.
Sure. Well, I mean, we aren't forecasting anything. But we will look at what it looks like currently. So just give me a second here. I'll see if I can pull it up. Okay, so let's look at a long-term picture. So gold peaked out in 2011, pulled back through 15, 16, 17, rallied, and broke out and made a new high in 2020. From which point it consolidated. Broke out of that consolidation and consolidated a little further, recently breaking out. So these are monthly bars. So we broke out in the month of February. and then rallied through the month of March, and we pulled back a little off of that. I think that this is a very, very constructive price pattern. One of the things that's important is that while rates on bonds have gone higher, they continue to be trading at a negative interest rate. So if you take the yield on bonds and subtract it from the inflation rate, we know that they are not giving a return in excess of inflation, and negative interest rates tend to be very good for precious metals. So I think whether we are facing inflation or whether we're facing political difficulty, gold probably makes some sense. It's an asset that underperformed for a long period of time and looks like it's in the right asset class, being commodities, and within the asset class, well set up for the current environment. So my guess is we probably work our way higher and the risk reward is probably very good.
Thanks, David. When we think about stop losses for particular equities, this gentleman, Robert, would like to know what, if you could have a couple different types of criteria that you consider when deciding to take a position out of the portfolio.
Yeah, so this is a tricky one. We're very systematic in our approach. For us, we come at making a security decision from 3 levels. So if 80% of return comes from being in the right sector and asset class, those are the first 2. So the question first off is breadth improving for equities? And we talked about earlier, breadth has been expanding. The percentage of stocks in uptrends is rising. That means we have a tailwind. So that means, first off, we're prepared to give positions a little bit more leeway. Then the second question is, of the 41 sectors that we follow, which are showing expanding breadth and which are showing contracting breadth? So I can tell you the vast majority of sectors currently are showing expanding breadth, meaning that the sectors have tailwinds. If sector breadth turns down, we become less tolerant of risk in that sector. If market risk turns down, we become less tolerant of overall market risk. In both cases, we would tighten up our stop losses to closer to the current market price. Neither of those is the case right now for any of the securities we're in. We have sector support and market support. At the individual security level, there's lots of reasons to decide to sell. One might be that fundamentally something starts to change. But from a price perspective, we use point and figure price charts to help us identify inflection points where something's changing. Now, not everybody understands how to use point and figure charts. They were invented by Charles Dow back in the 1920s. They're a little bit quirky. They're very quantitative and give us very clear points and price where the odds of success are changing. And maybe we'll do a session on that at some point over the next few weeks. I think some people could use moving averages, which I think is somewhat less relevant because so many investors follow moving averages. In fact, when securities trade down toward a 50-day moving average, often I believe hedge funds will push on the price to break below the 50-day to try and shake investors out. But you certainly could use a 150-day moving average, which is a long-term moving average, or a 200-day moving average as an alternative to that. So we're trying to make decisions for the intermediate term. We're not trying to make day trading decisions. We tend to use indicators that are a little bit longer term. But point and figure charts, I think, are the best. And then I suppose you could use long-term moving averages behind that.
Dave, last question is regarding the Canadian oil companies. I know that you just addressed how we look at stop losses in the portfolios. Did or would you think today was a good day to be purchasing oil and adding it to the portfolio?
Yeah, I certainly think that this pullback that we've seen, it could pull back a little bit further. But having said that, I think that the risk reward is pretty good. I mean, I'll pull up a point and figure chart here of CNQ. This is not Canadian Natural Resources. We've seen a series of higher lows and higher highs. This has been pretty consistent. This is the most recent high at $80. We pulled back here at $75. We're well above support down here at $71. So that's as one example. is one that we might take a look at. If we were to break $71 and trade $70, that would probably stop us out of part of our position, which is about 6 or 7% below where we are today. But we look at each individual security and look at its historical behavior and say, are we behaving the way that we think it should be, given the fundamental picture that we think that we have? But I know that I added today a little bit of uranium. I added today a little bit of copper exposure. We added today a little bit of steel exposure, Stelco and Cleveland Cliffs, on the little pullback that they had. But to put it in context, if we were to take Cleveland Cliffs, for instance, this is a stock that's just recently broken out. This is a long-term chart back to 2014. These are monthly bars. This is the breakout that's taken place in the last month. When we go back and just look at a yearly chart, this little pullback where we opened down about 7% today was probably a good place to add. Stelco, I think probably the same. We broke out of the range we've been in since 2021, pulled back into support. Those are the types of little pullbacks that we would buy. But if you look at the point figure chart, they show that they're rock solid on a point figure basis.
Dave, that's great. Thank you so much for taking the time to provide us with this overview. I will leave you, as always, with the final word.
Look, when you set up a new long-term bull market, we can pull back at any point in time. If we have some kind of near-term resolution or de-escalation with the conflict in Russia, it's possible there could be some sellers come into some of these things. I guess I would highlight that these long-term themes have been developing for years and have really only been exacerbated in the short run by the geopolitical event going on in Ukraine. Look, we don't expect these things to go straight higher. We do think that market is constructive. We do think that the market's broadening out. It's great to see things like cybersecurity, sharply rally and get back close to where the highs were. Semiconductor index is an unweighted semiconductor index, also making a nice move and clearing some resistance here. I think that's all very constructive. So we just got to take this day by day and month by month and week by week. And as we see changes, we'll pass them on to you. But in the near term, thanks for logging in. And hopefully you find this stuff useful. If you got topics you'd like us to target, please shoot us an email or give us a call. Or if you want to have a conversation, we're here on the other end of the phone. So thanks so much for tuning in, and we'll look forward to seeing you all again next week. Thanks, Pam.
Thanks, Dave. Bye, everyone.